Firms invest in other companies for a variety of strategic and financial reasons. Sometimes it's simply about putting excess cash to work through short-term marketable securities. Other times, the goal is to earn dividends and benefit from rising share prices. Investments can also open the door to strategic influence, such as gaining a voice in major decisions or electing board members. In many industries, equity investments create strategic partnerships in areas like research and development, technology sharing, or distribution networks. These motivations often shape the method of accounting that follows. The degree of ownership directly affects the amount of influence an investor can exert. If a company owns less than 20% of another, it typically has no significant influence and is considered a passive investor. But ownership between 20 and 50% generally implies significant influence, like having board representation or participating in key decisions. Once ownership exceeds 50%, the investor has effective control and can dictate operational and financial policies. Finally, even without majority voting rights, a company might control another through contractual rights or risk-sharing arrangements. These cases involve variable interest entities. Each level of ownership comes with a corresponding accounting method. When the investor has less than 20% ownership, it typically uses the fair value or cost method. With ownership between 20 and 50%, the equity method is most common, although fair value can sometimes be applied under certain standards. Ownership above 50% requires consolidation. The investor reports the subsidiary's assets, liabilities, and results as part of its own. BIEs are consolidated too, even when the investor owns no shares, if it holds primary decision-making power and absorbs the majority of the risks or rewards.